Hi, I'm Matt, and welcome to Matt's Money Matters. 2020 is a year going like none of us expected, but it's a good time to reflect on some of the biggest economic challenges of history, why they happened, and what society learned from them. And the number one lesson, even when things get really bad, humanity always comes out stronger in the end. So where do we start this journey? The Great Depression? The global financial crisis? Too basic. What about the crisis you've never heard of, where a depression was narrowly avoided in a way that might surprise you? The bank panic of 1907, when capitalism saved itself. In the years leading up to the 1907 crisis, there'd been a few challenges that shook investors, like the massive San Francisco earthquake, a government tightening down on monopolies, railroads, and big business, and financial flows with Europe were highly volatile. But the big problem came from one business, United Copper Company. The company had capacity to produce about 42 million pounds of copper a year, mostly in Montana. That's here for those of you who don't live in America. Actually, for those of you who do live in America, you probably need a map anyway, hey? It was controlled by the Hines family. F. Augustus Hines ran the show, and he had a mate who was a banker, Charles W. Morse, and a brother named Otto. And Otto had a genius idea. They owned a lot of United Copper stock, and they'd lent shares to short sellers. Short sellers are people who think a stock price will fall, so they borrow shares from someone and sell them in the hope to buy them back later at a lower price. "We'll buy more shares," Otto said, "and then when the price is up, we'll call in the shorts and we'll make stacks of dough. What could go wrong?" The share price went up, he called in the shorts. Little problem though, silly Otto got his maths wrong and the share price crashed. Let me just stop you there. Imagine being such a dumbass that your plan backfires within a day because you didn't know how many shares you had to begin with. Now, brother Augustus was on bank boards, and some banks had used United Copper shares as collateral for loans. And that is when the copper hit the fan, as it were. Otto couldn't pay his broker, so they went into bankruptcy. Augustus owned State Savings Bank of Butte, Montana, which was now insolvent. He was also on the board of the Mercantile National Bank, and that had a relationship with the State Savings Bank. So they said, "Get out of here, Augustus." Depositors rushed to take their dough out because they worried about the bank's solvency. If you put $100 in the bank will keep some of it and loan the rest out. And that's fine unless everybody wants to get their deposit out at once. And that's called a bank panic or a bank run. The bank will have enough assets to cover everybody's deposits, but a lot of them will be home loans or investments in the share market. They can't just turn it into cash like that. So it puts massive pressure on the bank and it goes under. Now here's a fun fact. A lot of old banks have massive lobbies because they didn't want queues of people lining up outside the door, because if you saw a queue of people outside your bank, you would think there was an issue and you'd line up too. And it got to the weekend. Everybody chilled out. Investment bankers in those days didn't do lines of cocaine, but they all had a cigar and a whiskey and relaxed. On Monday, people were asking questions about the Knickerbocker Trust Company, the third largest in New York. Now, banks weren't allowed to take people's trust funds, so the trust companies did. And they went very high risk. Trusts had been launching. They'd more than tripled in value in New York in the 10 years to 1907 and were worth about $1.4 billion, which in plain English is loads of money. One of the directors of the Knickerbocker Trust had been a close business associate of the Hineses, and the other directors were alarmed by this, so he was asked to resign. But it was too late. Confidence was shaken, and people started withdrawing their deposits. If one bank doesn't have enough money to pay off all its depositors, that problem can quickly spread across the financial system because different banks have loans to each other. If you've got a $10 note from work, you might go to Walmart or Kohl's and use it to buy some stuff, and then it goes into the till, and then it's used to pay the guy behind the checkout, and he goes to a bar and uses it to buy a cocktail. That one $10 note finances a number of transactions. So to be clear here, the number of times a bank reloans an original deposit is called the money multiplier, and the number of transactions one note finances is called the velocity of money. If the velocity, the money multiplier, or the amount of money in the economy changes significantly, it can have major impacts. If the numbers go up a lot, you get inflation. If the numbers go down a lot, you get a deflation. That's what happened in the Great Depression. And that can be a massive problem. So it's understandable why people on Wall Street were a little bit uncomfortable with what was going on. At this point is one of my favourite moments in the history of capitalism. Enter John Pierpont Morgan. You've heard of JP Morgan Bank, which is named after him. He was the creator of US Steel, one of the world's most famous tycoons. He got in his rail car, private rail car, to come up from Virginia to New York over the weekend to save the day. And just how did this man, one of the most successful bankers in history, save the American financial system? Well, that is a story for episode 2.